This video contains meaning of financial accounting. It is in Chapter 1, named Introduction, of the textbook, Management Accounting. This is more suitable for B.Com, B.B.A, M.Com and M.B.A of all universities of India and foreign countries. It is suggested to study through laptop. Presented by Dr.M.Wilson. Chapter 1, Introduction. Accounting is considered as a process of recording the financial activities of a businessman. The concept of accounting existed in the very olden days itself when the activities of trading started in the history of human beings. It is believed that the accounting system existed during 4500 BC itself, in the ancient civilization of Babylonia and Assyria. The businessman need to know the profit or loss in his business, and hence, he recorded the financial transactions. The accounting system adopted in the early periods got a good shape due to the introduction of double entry system in the place Geneva of Italy during 1340. This system was properly developed by Fra Luca Pacioli, an Italian, in the year 1340. In the initial period, the accounting system is meant for recording the historical financial data for the calculation of profit. Later on, due to the economic and social developments brought by Industrial Revolution, the scope of the accounting increased to a very great extent. This is due to enormous growth of business units leading to high competition. Hence, companies are compelled to reduce the cost to face competition. In this respect, there is a need for analysis of the financial information so that more information can be generated for planning, decision-making and cost control. This in turn developed new branches of accounting apart from financial accounting of the earlier period. The new branches of accounting are called cost accounting and management accounting. Hence, it is not proper to give a clear introduction about the management accounting without briefly explaining the important aspects of financial accounting and cost accounting. 1. Financial accounting. The accounting that developed first and still exists is known as financial accounting. But the terminology used at that time is accounting only. Hence, the definition of accounting implied to mean financial accounting. The best and suitable definition is given by the Committee on Terminology of American Institute of Certified Public Accountants. According to the committee, accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events, which are in part at least, of a financial character, and interpreting the results thereof. Hence, accounting is the art of recording financial transactions in order to ascertain the net result thereof. The net result of the business is ascertained through financial statements, namely, profit and loss account and balance sheet. The profit and loss exhibits the profit or loss and balance sheet exhibits the assets and liabilities in a financial year. The meaning of financial accounting is further known through its functions and principles. Functions of financial accounting. 1. Recording the financial transactions. The primary function of financial accounting is recording the transactions. The transactions are first recorded in a book called journal, and from journal it is transferred to other books which are called subsidiary books, ledger. 2. Classification. The recorded transactions in the journal are classified according to the nature of transactions. The classified transactions are properly recorded in the name of different accounts. This process of recording in different accounts is done in a book named as ledger. 3. Summarizing. The classified transactions which are recorded in ledger are represented in the form of many accounts. This should be brought into a summarized account form. The summarization process is carried out through a statement called trial balance. From the trial balance, the summarized accounts are prepared as 1. Profit and loss account and 2. Balance sheet. 4. Concerned only with financial transactions. Financial account is concerned only with the financial transactions. The non-financial transactions like motivational factors, communications, etc. will not be recorded in the financial accounting. 5. Interpretation. The financial data recorded in the books are properly interpreted so that it can be used by the owners, financial institutions, creditors, government and public. The parties interested should have an idea about the company through proper interpretation. Principles of financial accounting. Principles are concerned with the rules and regulation for the proper recording and maintenance of accounts. Principles of accounting are classified as A. Accounting concepts and B. Accounting conventions. A. Accounting concepts. 1. Business entity concept. This concept is based in the principle that business is entirely different from businessman for the accounting purpose. The capital contributed by the businessman is considered as the liability for the businessman. Like that, the businessman expects fair returns for his capital from the business. 2. Going concern concept. This concept states that the business will exist for an indefinite period or at least for a fixed period in future. 3. Cost concept. The assets of the company is valued on the basis of cost only. Like that, all the liabilities are considered. All transactions are recorded on the basis of objectivity and not on individual opinion. 4. Concept of dual aspect. All the transaction are classified into two aspects as debit and credit and recorded in two accounts. This is called dual aspect. 5. Money measurement concept. This concept states that all the transactions which can be measured in terms of monetary value only should be recorded in the account books. Non-monetary transactions should not be recorded in this system of accounts. 6. Accounting period concept. According to this concept, the expenses or revenue meant for a financial year should be considered in the preparation of profit and loss account and balance sheet. The expenses, whether paid or not, income whether received or not, should be recorded if they are meant for the financial year. 7. Realization concept. This concept states that revenue is realized through sales, and the sales value may be realized immediately as cash or through debtors and then cash from them. 8. Matching of cost and revenue concept. According to this concept, the cost and revenue are matched in the profit and loss account and balance is transferred to balance sheet so that the assets and liabilities aspects are matched. B. Accounting conventions. Convention means customs and traditions which are universally followed. The important conventions of accounting are stated as follows. 1. Convention of disclosure. The important convention is disclosure of all the relevant accounting information so that it may be properly used by the parties interested in the company. 2. Convention of consistency. It means that the principles adopted for preparing the accounting statements should be same for all the periods. Moreover, it shall be universally accepted. 3. Convention of conservation. Conservation means safety measures with respect to the loss in future. Proper reserves should be maintained for meeting the losses in future. 4. Convention of materiality. This convention states that only events of significant importance should be recorded. Insignificant information should be ignored and not recorded in the accounts. Limitations of financial accounting. Financial accounting is providing information to owners, creditors, financial institutions, public and government. In spite of its many advantages, it has few limitations, and the important limitations are stated as follows. 1. Provides only historical data. It provides only past data in the form of profit and loss account and balance sheet. There is no analysis carried on in financial accounting for planning and cost control for future. 2. Provides only limited information. The information provided are only related to financial operation. The data related to cost at different stages of production or the rate of growth in various activities are not provided by financial accounting. 3. Provides only quantitative information. It provides only quantitative information. The transactions which can be represented in monetary terms only are recorded in financial accounting. The information like performance of individuals are not recorded in this accounting system. 4. It will not help for price fixation. Fixation of price is a crucial factor for a concern. The information provided by financial accounting will not be useful for fixing the prices. 5. It will not provide tools for cost control. Since financial accounting is not concerned with the cost of production and cost of different activities carried on in a concern, there is no tool for cost control in this system of accounting. 6. It is not possible to measure the comparative performance. The comparative performance related to operating and financial activities for different periods and for different activities could not be measured in financial accounting. 7. It will not provide information to management for planning and decision making. Financial accounting is not providing any information related to planning, control and decision making. It is only providing the profit or loss information and financial status of a company. 8. It is possible to manipulate accounts. In financial accounting there is possibility of manipulating accounts to show a good picture about the company. The fixed assets may be overvalued, low rate of depreciation may be charged to fixed assets, etc.